Hi everyone, welcome to another episode of the Patient Wellness channel. In today's episode, we have a few things to get through. Firstly, I'll go through a portfolio update, see how my investments are doing, and talk about my recent buy. I'll then go through Adobe's earnings. The company reported in double beat last week, but the stock is down. I'll answer a subscriber question and then reveal my passive income for August. Before we start, keep in mind this video is for educational purpose only, so make sure you do your own research before you take any financial decisions. Okay, let's jump straight into the video. So it's been approximately 2.5 months since I restarted investing. The total portfolio value is £8,583 and the total gains, as we can see from here, it's around £750. As we can see from this table here, Google is up 27.1%, Amazon is up 3.1%, FICO 0.9% and Adobe is down 1.1%. Year to date, the only company that is outperforming the S&P 500 is Google, and thankfully is my largest position. The portfolio allocation is 43.4% in Google, 31.3% in Amazon, 13% in FICO, and 12% in Adobe. On an aggregate level, I feel pretty comfortable on the portfolio KPIs. The 3-year revenue CAGR is 10.8%, diluted EPS 3-year CAGR is 38.8%. All companies have high profitability margins. Gross profit margin is 63%, operating profit margin is 28%, and net profit margin 25%. These companies have high return on investment capital and return on equity, as we can see here. The P is 33%, the forward P 29%. Net debt is a negative 1.5 billion, suggesting that the net cash position is positive and the free cash flow yield of the portfolio is 2.2%. My goal over the next couple of months is to continue to build out the core positions of this portfolio, and this brings me to my last week's purchase, which was 6 shares of Amazon for a total cost of £1,023, and there are 3 reasons that I bought Amazon. Firstly, Amazon is underperforming the S&P 500 year to date, as we can see here, as the market doesn't appreciate the operating leverage that Amazon can exercise. Factor number 2 is that I expect Amazon businesses to continue to grow. We have here the revenue breakdown of Amazon, which includes the online stores, the third-party sellers, we have physical stores, advertising, subscription services revenue, AWS, and other revenue. As we can see from the chart, all of these businesses are growing over time. I expect them to grow, but there is also the optionality and additional growth that will come from Zoox and Project Kyber. And lastly, factor number 3 is the way that Amazon leans in when they see growth opportunities. This chart here shows the capital expenditure of Meta, Google, Microsoft, and Amazon. As we can see, Amazon invested much more than the rest of the big tech companies, and they've done this twice in the recent past. They've done this between 2020 and 2022, where they doubled their fulfillment centers, and they're doing this again for cloud infrastructure and AI investments. And I expect these investments to bear fruits down the line for shareholders. Okay, let's now move on to Adobe's earnings. The company reported earnings on the 11th of September after market close. The stock price originally spiked, but then fizzled out, and the company now trades below what was trading prior to earnings. I made a video on why I invested in Adobe, so go and check that out. At a high level, I invested in Adobe because it trades at a low valuation, in my opinion. The market narrative is that AI will kill their business. I believe AI will enhance their business over time, and I like the approach they took on training their models on licensed data, which means users will avoid any legal risks when using their models. I went through their investor reports and listened into their earnings call, and I think the highlights are as follows. Adobe reported strong financial results for the third quarter of fiscal year 2025, achieving a record $5.99 billion in total revenue. This represents an 11% year-over-year growth as reported, or 10% in constant currency. GAAP diluted earnings per share reached $4.18, reflecting an 11% year-over-year increase. The company's AI-influenced annual recurring revenue has surpassed $5 billion, with new AI-first products like Firefly, Acrobat AI Assistant, and Gen Studio for Performance Marketing already exceeding their end-of-year target of over $250 million. Based on this momentum and strong execution, Adobe has raised its full-year FY25 targets. The revised outlook projects total Adobe revenue between $23.65 billion and $23.70 billion, and GAAP earnings per share are now targeted at $16.53 to $16.58 for the year. A few interesting things to highlight from the earnings call. We had the following question: just wondering if you could shed a little bit of light on the mix of AI credit usage between your own Firefly-based solutions and third-party, whether you're seeing any pickup from the third-party models and how users are responding. Management's response was that the majority of generation continues to be Firefly given the commercial safety and the underpinnings of what that is. This highlights that Adobe's models are continuing to be used and the safety feature is an important one for its users. We had another question around LLMs. The question was how Adobe will help its users to adopt on the way that the web shifted from a traditional search-based to now LLM-based information discovery. And management comments around LLMs were as follows. Customer acquisition is being disrupted as brand discovery shifts from link-based search results to include LLMs. Brands need to win visibility through LLMs by providing machine-readable content and real-time updates while strengthening their direct relationships with their customers. Adobe is uniquely positioned to help businesses orchestrate and deliver personalized customer experiences by fusing creativity, marketing, and agentic AI. Our AI-first and AI-infused solutions spanning Gen Studio for content supply chain, AAP and apps for customers' engagement and loyalty, and Adobe Experience Manager and LLM Optimizer for brand visibility and discovery enable us to power customer experience orchestration in the era of agentic AI. So Adobe's LLM Optimizer will help its user and their brands to show up in LLM results, which will then drive influence, visibility, and qualified traffic. And the last thing I'm going to highlight is a question around how AI is impacting retention. This is part of my thesis, as I think the AI layering across Adobe's products will help with customer retention, raising prices, and over time improve the margins for the business. The question was, so can you just talk about what you are seeing in terms of retention trends as AI adoption grows? And management's answer was very clear. The thing that we have seen is a direct correlation between increased use of AI and retention. So we are feeling good. This basically validates that AI infusion helps with customer retention, which should be a net positive for the business over the longer term. Okay, now we are going to look at the hard data. Revenue, as you can see, is going up and to the right, growing quarter over quarter. Subscription revenues are becoming a higher percentage of total revenues over time, and they are continuing to grow. Free cash flow per share is now growing and at the highest level for the last 5 years. It grew 54% year over year. Diluted earnings per share show a similar story as they are increasing and grew 40.6% year over year. The company maintains high returns on invested capital and they are growing over time. Management is continuing to buy back shares with the diluted weighted average number of shares decreasing by 3.8% year on year. And all of that is happening as the stock price has been going down over the last 2 years. Adobe is now trading at the lowest level of forward PE ratio over the last 10 years, with the current forward PE being at 15.3 times, and similarly trades at the highest forward free cash flow yield that has been trading over the last 10 years, with the current level being 6.7%. So my take from this earnings call is that management continues to execute well. My investment thesis remains intact as I haven't identified any red flags. Hard data is showing us that fundamentals of the company are growing and moving towards the right direction, whilst the stock price continues to go down as the market narrative is AI will kill their business. So personally, I remain invested. I think Adobe is a buy at these levels, and if the stock price falls further, I might buy more. Moving to the question, I received this great question from No Ordinary Experience 7815 user. Can you do an episode on when to sell, cut losses of a falling stock? My response to this and the way I'm thinking about this is I'm selling a stock if the investment thesis that I invested in a stock does not play out and is worsening over time, then I'm selling the stock. And as an example, I've been talking about Adobe in this episode, and my investment thesis is around the fact that AI will help their business grow, not kill their business. As we have seen on the earnings call, it seems that using AI helps with customer retention. So my investment thesis remains solid. There are no red flags that I have identified during this earnings call. And as a result, I remain invested. If on the other hand, I identified red flags, for example, revenue or subscription revenue dropping, I would then revisit my investment thesis. And if I was not happy with the risk reward profile of a company, I would sell out of the company and move on. I also think revisiting your investment thesis is important to identify any new red flags or new opportunities. It's important to have strong conviction about the stock and try and focus on hard data to avoid emotions. And I'll give you an example from my past investment journey. As you'll see from my Trading 212 account, I used to invest in Meta, and I started investing in September 2021 and my last buy was in November 2022. During that period, the stock price was down 76%, but because I revisited my investment thesis, I had the strong conviction, all I saw was I'm buying a high quality company, but now it's trading at around 75% discount to what I used to buy. The result was that Meta was one of my best trades, and when I sold in December 24, I made a good chunk of money. So, sell a stock and your investment thesis changes and you no longer have strong conviction about the future performance of a stock. Okay, moving now to passive income. For the month of August 2025, we received £502 in passive income. All of this income comes from stocks and cash ISAs. Over the last 12 months, our passive income was £5,096. As a reminder, this took us a long time to get here, and as you can see, back in June 21, our passive income was zero, but over time we remained consistent, kept saving, investing, and now earned £502 over a single month, which is great. That's it for this episode. Like and share the video, subscribe to the channel, and I'll see you in the next one.